Thank you very much. So thanks very much for the introduction. I thought what Martin said was spot on. You know, the role of the stock exchange has definitely evolved over time. I started out my career actually as a trader. So I ran trading for the Royal Bank of Canada. I traded energy stocks, I traded technology stocks, and in a way kind of found myself in a very unlikely situation, being the main character of Michael Lewis's latest book, Flash Boys. And it's funny because I actually started and I met Michael Lewis and I was helping him write an article about someone else. A high-speed trader had left a large bank and actually got thrown in prison for taking computer code. The FBI arrested him at Newark Airport, took him to jail, and his lawyer called Michael Lewis, he knew him from a previous life, and said, "You have to write this article about my client. He got thrown in prison and no one knows what he actually took." And that led Michael Lewis down the topic of high-frequency trading. So he wrote a book called The Big Short, and a couple characters from there are friends of mine, and they said to him, as he was asking questions about high-frequency trading, they said, "You should talk to Brad." So I spent a couple months really talking to Michael Lewis, giving him background, and he never really asked about what we were doing. He asked in general how I knew these things and how I kind of came to discover some of these issues, but really never took an interest in writing about IEX or me. And somehow, as that conversation evolved, then he got deeper and deeper into the subject. He became interested in us. You know, Flash Boys took on a different kind of a trajectory because it actually was kicked off with an episode on 60 Minutes. 60 Minutes, I'll never forget, it was actually my first time ever on live television was 60 Minutes, and I interviewed with Steve Croft. And Steve Croft, the interview was 3 hours long, and I knew that the segment was 12 and a half minutes. I knew there were 4 people on the segment, so my part would be about 2.5 minutes, so 3 hours of filming down to 2.5 minutes of airtime. And he kept kind of like tiptoeing around the subject. I would explain a concept to him and he said, "You know, it sounds like the stock market's rigged." And I'd say, "No, it's more complicated than that." And so we'd go off to something else and we get on another topic and I tell him about, you know, this exchange is selling this micro retire, and he's like, "That sounds like rigging to me." And I was like, "Well, no, it's kind of more complicated than that." I could kind of get what he was saying, you know, what he was trying to get at. I wouldn't say, I'd said it many times before, but I was never going to say it on 60 Minutes, that was for sure. So 60 Minutes, the week before it comes out, I'm sitting on a couch, sitting on my couch with my wife, and I pull up the preview. Michael Lewis is there on the screen, and Steve Croft says to him, "What's the headline?" And he said, "The United States stock market is rigged." And I just went, "Oh my God, no, I can't." Michael Lewis says it on national TV. It's in the preview. So I call Michael, and I say to him, I said, "Michael, why in the world did you say the stock market's rigged?" And he said, "Well, let me ask you a question." I said, "Okay." He goes, "Is the way the stock market has been designed, does it systematically disadvantage certain people?" And I said, "Yes, of course you know that." And he goes, "Well, what would you call it then?" So the funny part about it is that rigged is a word. I have my money in mutual funds. I don't think the investment process is broken by any stretch of the imagination. But when you ask the question, is the stock market, the way it's designed, does it systematically disadvantage certain people? The answer to that is yes. And I'll explain to you exactly why that is. And I think over the course of time, what's happening is the playing field is getting more level. And as Martin indicated, the people who are being systematically disadvantaged are the people who know the least about the stock market. So back to the beginning here, my career. Started as a trader. I traded energy stocks, I traded technology stocks. I cared about fundamentals of companies. This is a typical screen. This is from Google Finance. I would use Bloomberg or Reuters. My job was I traded on behalf of mutual funds and hedge funds. I was an institutional trader, and I actually ended up running all of risk trading for Royal Bank of Canada in US equities, which meant that if a mutual fund wanted to buy 1 million shares of Advanced Micro Devices, AMD, I'd pull up a quote, I'd look on the offer, and I'd see that there's 115,000 shares offered at $2.91. So in 2006, if I wanted to buy 100,000 shares of AMD, $2.91, I'd type that into my computer, buy 100,000, $2.91, enter, it would go out, and I would buy 100,000 shares of AMD at $2.91. But in 2007, when I would try to do exactly that same thing, I'd only get 80,000 of the 100 that I saw. And in 2008, I would try to buy 100 and I get 70,000 of what I saw. In 2009, I tried to buy 100,000. I get 45,000 of the 100,000 shares that I saw, and it drove me insane. I do what every trader does when they think their computer's not working. I'd call tech support, and the guy would run out of the back and say, "What's going on?" I'd say, "Watch this. I see 50,000 shares at $2.93. I'm going to try to buy that. I will only get a fraction of what you and I see on the screen." And I try to do it, and I get 15,000 shares. And I say, "What do you think is happening?" And he says, "Well, I think that there's more people that want to buy AMD, and it's not just you," meaning that you're part of a market that's moving very quickly and many people want to trade. And I said, "Okay, well, I'll prove you wrong." I say, I'm going to try to buy 45,000 shares at $2.95, but I'm not going to press this button for 5 seconds. And if while I'm counting the stock's trading, you're right, other people want to buy AMD. I said, but nothing's going to happen until I press this button. So I'd count to 5 or 7 or whatever. I could change it, it doesn't matter. And then I'd hit the button, and that's when the stock would move. That's when the offers would disappear. And I'd say to them, I said, I'm the event. This is not a random occurrence. The only reason people want to buy AMD is because I want to buy it. I had no idea why this was happening. It went on for 2 years. Right? Michael Lewis, I think some people, if they haven't read the book, kind of would view me as a disruptor, and that's like the opposite of what I am. I spent my entire life getting along with people. This is not, in a million years, I never thought I'd be in the position I'm in right now. This went on for 2 years. Myself, my traders, we just dealt with it. It became common knowledge that if I saw 500,000 shares of a stock on the offer, that I would only get a fraction of what I actually saw. I got really lucky. In 2009, RBC offered me an opportunity to run what's called electronic sales and trading. And what that meant, in a nutshell, is I went from managing a group of people, human traders, to computer programmers and network engineers that were building algorithms that our traders would use. So I went from managing traders to managing people who built programs and algorithms for those traders. I actually didn't want the job. So my first answer to them offering me this job was actually no. And it's funny because life is a lot about decisions and a lot about luck. And for some reason, my boss kept persisting. I think you should really take a look at this job. I didn't want to do it. Actually, funny story is that we had bought a company, terrible company. We bought it in 2007. They were supplying the technology that we were using, and I actually thought they were partially responsible for the fact that I couldn't trade. We buy this company, it's a pile of garbage, and I can't trade. They fired the CEO, and they wanted me to take that company over, and I just didn't want to do it. I went out, and I said, okay, I'll do a little bit of due diligence to see if I want to take this job. And I went out and I sat with a friend of mine who actually worked at SAC Capital in Stamford, Connecticut, Steve Cohen's fund. And I said, if anyone has the best tools, algorithms in the market, it's SAC Capital. So I sat with a trader from SAC. He was using algorithms from Goldman Sachs and Credit Suisse and Morgan Stanley, et cetera, et cetera. He could not buy or sell what he saw on his screens either. And that was the first time where the light bulb went off in my head to say, this isn't an RBC problem. It's not a crappy technology problem. One of the biggest hedge funds in the world is using tools built by all of the largest banks, and he can't buy or sell what he sees on his screen either. At that point in time, I actually knew the problem was systemic. So I took the job because I really wanted to figure out what was happening. And it turns out that some of the people that again, life has a lot to do with luck. I was hiring people in the spring of 2009. That's when I took the job. And if you look at a chart of the S&P, the absolute bottom of that chart is spring of 2009. And all of a sudden, I could convince a bunch of people who never in their wildest dreams ever wanted to work for the Royal Bank of Canada, that the Royal Bank of Canada was actually a pretty good place for people to work. So I built a team at RBC. For the first time also, I started to read about high-frequency trading. I had no idea what that was, but I knew that it sounded pretty important, and I needed to hire people from that industry, and I did. And what some of the people from the high-frequency trading industry explained to me was that the 100,000 shares of AMD that I saw on my screen wasn't just at one stock market, the New York Stock Exchange or NASDAQ. There were actually at the time 13 different stock exchanges in the United States that were geographically located in different buildings. Now the geography actually is important here because what that means is that when I see 100,000 shares on my screen and I try to enter an order, me pressing the button once isn't just one action. Me pressing the button once sends one message to something called a smart order router. It splits my order up into as many as 13 different messages and blasts them out to the stock exchanges. This is going to sound crazy, but RBC at the time, we were located in downtown Manhattan. All of the exchanges were in New Jersey, which is west of Manhattan. So what that means is that my one order to buy 100,000 shares of AMD, let's say there's 25,000 shares offered at 4 exchanges, BATS, Direct Edge, NASDAQ, and New York Stock Exchange, the 4 biggest exchanges at the time. I would blast 4 orders out to the market from RBC, and they would arrive in sequence first at BATS, because BATS is located in Weehawken, New Jersey, right on the other side of the Lincoln Tunnel. It's closest to Manhattan. Then Direct Edge and Secaucus, then NASDAQ and Carteret, and the New York Stock Exchange built a new, I heard, they spent close to $1 billion building a data center in Mahwah, New Jersey, and one in Basildon. It would arrive there last. It was 60 miles away from NASDAQ. The difference in time, this is going to sound completely bananas, but was 2 milliseconds between arriving at the first and the last exchange. At the time, I thought that was actually pretty fast. It's 300 milliseconds to blink your eye. 2 milliseconds to me seemed pretty fast, except for the fact that one of the people I hired, this guy by the name of Ronan Ryan, had just come from building out high-frequency trading infrastructure for some of the biggest high-frequency trading firms there were. And he said, I got bad news for you, Brad. I can get from one building, BATS, to the next in 476 microseconds. A microsecond is 1/millionth of a second. He could actually get there 4 times faster than I could, which meant that as my orders were going out to the market, we would arrive at BATS first. Ronan's clients would pick up a signal and race us to Direct Edge, NASDAQ, and New York. And they were doing 2 things. One is they were canceling their sell orders. Now that they know a buyer has come in and bought everything, all of the AMD shares at $291 on BATS, they're racing out to cancel any sell orders they have in the market. But second, they're also trying to buy shares ahead of me to sell back to me at a higher price. And this is what was happening. After Ronan explained this to me, I said to him, well, can we get faster? And he said, well, we're the Royal Bank of Canada. We will never be faster than anybody, right? So getting faster was not a solution. There were things that his clients were doing that we would never do. A funny story is that also proximity, where you're located in the data center. So now that I've paid to be in the data center, where you are in the data center matters. And he said that next to one of the big stock exchanges, Toys R Us actually owned a cabinet next to one of the big stock exchanges by accident. They were there. They were probably running their website or something like that from there. And he said he was working on behalf of clients trying to pay Toys R Us insane amounts of money, and they finally gave in. They finally sold their space, and they wanted to leave Toys R Us as the identifier on the cage because they didn't want anyone to know who was in the cage. Proximity matters, and they spent a ton of money on that. He said we cannot be faster than them. But the one thing we could do was get slower. And at the time in 2009, this sounds crazy. Every big bank out there was selling to their clients. We're the fastest, we're this, we're that, we're microsecond, we're nanosecond. And we said, you know what, we're going to get slower. And what that means is slow down our fastest connections to try to get all orders to arrive at all exchanges as close to simultaneous as possible. And in theory, the way to think about this is send the order to New York Stock Exchange first, send the order to BATS last, to arrive simultaneous, and we actually were able to do that. We got our arrival variance down to 290 microseconds. It is not as easy as this diagram makes it look. It was actually very, very hard to do because latency changes. At the beginning and end of the day, there are more messages on the network because of the open and the close. Latency fluctuates. So this was actually something where we had to use messages in a real-time basis to calculate variances between exchanges, but we got our variance down to 290 microseconds, which meant I could now buy or sell everything I saw on my screen. This was the easiest product in the world to sell. I'd walk into any asset manager out there and I'd say, you want to buy Bank of America, you see 2 million shares in the offer, how much of that do you get? People would say anything from 500,000 to 1 million shares. I said, I'll get you all 2 million. And they would say, give me the product. The product actually it took RBC from 19 to number 1 in the Greenwich Associates survey in 1 year. It was a $100 million product in less than 18 months. The problem is that clients couldn't just trade with RBC. One of my closest clients put it to me brilliantly. He said, Brad, you've solved 2% of my trading problem. I was like, what do you mean? He goes, 2% is the amount of trades that I can actually send to RBC. He's like, what about the other 98% of my trading issues? So this actually got us thinking quite a bit. We wanted to understand, a lot of people villainize high frequency trading. And I think, again, not every person that uses a computer to trade is harming the market. If you're arbitraging an ETF against the 30 underlying stocks, a computer does that. There's nothing wrong with that. If there's an ADR that's listed in London, it trades in New York, there's nothing wrong with arbitraging correlated products. But there are some high frequency traders that are actually picking up signals and racing. We call this latency arbitrage. But high frequency traders have no customers. They're capitalists in many ways, and again, some slant on capitalism, but they're looking at an inefficient system, and they're saying, how can I capitalize on that? On the other hand, how can someone pick up a signal at bats and race me to another exchange and get there in 476 microseconds? And the answer to that is because stock exchanges themselves aren't exactly what you think stock exchanges are anymore. A lot of people think about New York Stock Exchange and think about Wall Street and the big bell ringing on CNBC. They think about NASDAQ and Times Square, but in reality, no trading happens in these buildings. The irony of it is that the floor of the New York Stock Exchange, the people on the floor have never been farther away from the actual point of sale because all of those orders are beamed out to data warehouses in Mahwah, New Jersey and Carteret, New Jersey. That's where all the trading happens. So this idea about proximity on the floor of the New York Stock Exchange on CNBC, it's not relevant because all the trading happens in these data warehouses. We started to ask ourselves questions, back to Martin's introduction, why does a stock exchange exist? If you sit back and you ask yourself, why is the greatest question in the world? I started IEX because I would just incessantly ask these questions to myself. A stock exchange exists to help companies raise capital, to ensure that those companies meet certain standards, and to help that capital and that equity change hands between investors in a just and equitable way. That's why a stock exchange exists. Except you start to read articles to say, well, hold on a second, why are exchanges creating complex order types? 2009, the way I learned about high-frequency trading is a stock exchange called Direct Edge built something called a flash order, which would give people a preview of an order before sending it on to another stock exchange, essentially a free look. Exchanges collectively in the United States pay $3 billion plus in what are called rebates. This is like figuring out that the electricity company pays you to turn your lights on. It was something that just completely baffled me when I learned it, but they're paying people billions of dollars to trade, which means they don't actually make money from trading anymore, which is why they open data centers, to sell people access, to sell people technology, to sell people cabling. They've even gone as far to put microwave towers on the roof of the exchanges to beam orders back and forth faster. Because all of this really adds up to the 476 microseconds that Ronan needed to beat me. It's being sold to him and his clients by the stock exchanges. The stock exchanges were enabling the issue that I just explained to you, among many other issues. We only have a few minutes here, so I can't get too deep into them. A stock exchange exists to help companies raise capital, to help investors allocate that capital. They do not exist to sell this stuff. But why do they do it? So first of all, they sell fast data, right? If you want to learn about the changing of a price faster than someone else, you have to pay for it. If you think about it theoretically, though, there isn't anything technically wrong with someone getting data before someone else, because there's no way to ensure that everyone gets it at the same time. If I broadcast a signal from this stage, everyone in this room will get it first. Maybe someone in the front row will actually get it technically before someone in the back. Definitely before someone in New York will get it or someone in San Francisco will get it. There's no way to ensure everyone gets data at exactly the same time. The problem is, the person with advanced information, how do they monetize the information? They monetize it by trading against someone who doesn't yet have it. That's why, let's Insider trading. I'm a lawyer, I work on a deal, I find out that company XYZ is going to get bought out. There's nothing illegal about me possessing that information. There is something wrong with me running out into the market before it's announced and buying up stock of XYZ. That's a problem. And here what you have is you have people, because you can't ensure everyone gets information at the same time, some people know something before someone else. Why do people pay hundreds of millions of dollars for the technology to be right next to stock exchanges? Because it gives them the ability to trade hundreds of times, thousands of times, before that same piece of information makes it to the last person. Let alone the fact that you're processing that many times with your eye and you're thinking about it. I mean, we're talking about microseconds here, right? So they sell technology to allow people to capitalize on the advanced information that they're selling them. And what's really happened is it's led to the rise of what's called high-frequency trading. August 24th, when the market went haywire, high-frequency traders were greater than 50% of the volume. They are every single day. I mean, back in 2012, in the fall of 2012, we had seriously volatile times, and one of the big clearing firms, the head of a clearing firm, said 75% of all of our volume today was high-frequency trading. So when the majority of volume in the markets is traded by people who do not care about fundamentals, what does that fundamentally mean for the stock market? It's a pretty scary thought, right? So what did we do? We decided to build our own stock exchange. It's kind of a crazy endeavor, and many people thought we were insane. And the mission was to become the most trusted and fair market operator in the world. Bold thoughts. We had things in our core values. Most importantly was act with integrity. Now, these are probably part of every company's mission. A lot of people talk about it. We wanted to live it. IEX was co-founded by myself and 8 other people. Here's a little snapshot. We worked in a 200 square foot office with no windows. We sat there for a year. It was a very depressing year, but that's what we did. Now, it kind of was a bit of a pipe dream to think that 9 people in a 200 square foot windowless room could actually build one of the fairest and most trusted markets in the world, but that's what we set out to do. The problem was we had no money. When I was at RBC and this problem came up from time to time where clients were saying, I can't pay RBC, I can't trade with RBC, we came up with the idea there, and I talked to a bunch of the largest asset managers in the world, and they all convinced me that it was a great idea to start IEX. And many of them said, yeah, we can give you money, we can give you money. And the stupidest thing I ever did in my life is that I quit my job without actually getting that in writing. So next thing you know, I find myself in the street in this 200 square foot room, and no one was giving us any money. And thankfully, the Capital Group was the firm that said, you know what, if you can get 9 other investment managers together, including us, you can use our name, we'll fund this. The problem is that they weren't the first people to track us down. Right after I left RBC, there's different sources of money to start stock exchanges. The number one source are the banks and the brokers themselves. I probably had about 15 offers to fund IEX within a couple months of leaving RBC. This is where the money was coming from. There are 50 stock markets in the United States. New York and NASDAQ are both publicly owned. Every single other stock market in the United States is owned by a bank, except IEX. So the banks went out there, and banks love to fund their own disruption. So they were like, hey, you guys are leaving RBC, we'll fund you. That's where the easy money was coming from. The problem with the banks is that although they are good partners, they have a lot of flow, there's a conflict of interest in a bank owning their own private stock market. They're responsible for trading client orders, and yet they own a stock market. How do they treat that stock market against all the other ones in the market? And it also limits our ability to disrupt. There's no way in the world Flash Boys would have ever been written if we were owned by banks. The exchanges. We had a lot of offers from exchanges to help fund what we were doing. They have a lot of money. The problem is that we wanted to compete with them, and their goal was to maintain the status quo. Exchanges are making a lot of money, selling data, selling technology, etc. They were not the right place. The right place was the end user, right? You talk about mutual funds, you talk about hedge funds, you talk about family offices, you talk about pensions. They were the right people. There's no conflict, but the problem is it had never been done before. So we were asking people to do something that had never been done before, which took us a very, very long time. We could have caved in. When I've done speeches at South by Southwest and startup conferences, et cetera, and what I say is, who you raise money from is more important than how much money you raise. Because who you raise money from will change the trajectory, it'll change the direction, it'll change your decision making. You have to raise it from people who are aligned with your goal of what you want to build. And that was them. So it took us 9.5 months to raise money. The IEX almost never happened many, many times. But we ended up raising $9.5 million at the end of 9.5 months. The problem was that was not enough money to start a stock exchange, but it was enough money to start a dark pool. Whoever came up with that name, I have no idea, but that's what we started at IEX, and we were the 40th ranked dark pool, the 50th ranked market in the United States. That's how we started. In the end, our owners, Capital Group, Greenlight, Brandis, Franklin Templeton, Spark, Bain Capital, none of these people can trade directly on our market. We only have banks that can trade on our market. So one of the most common conflicts in the market is when you own something, you have a fiduciary responsibility to somebody else, and you're directing trades there. The challenge becomes is that we didn't want anyone who was a member of the IEX market to also be an owner. The banks are our members, they are our clients, our owners are the asset managers. And in a way, we sit in between both of them. We're aligned with the asset managers and the banks are our clients, which means we can kind of help influence how the banks interact with us because they know that we're owned by their end client. It's kind of this triangle. Getting the money helped us hire more people. We hired people from the New York Stock Exchange, from NASDAQ. We even got people from the SEC. We've actually had quite a few resumes from the SEC. What we do in a nutshell is there's a huge value to being close, because the closer you are to something, the faster you can get the signal. And what we've done at IEX is we've slowed everyone down by an equal amount. We actually did this. We simulated physical distance. That little box there in the middle, we've coiled 38 miles of cable in a box. And it creates 350 microseconds, millionths of a second, of a delay. And that delay actually deters many of the high-speed trading strategies that require speed to race ahead and electronically front-run other people. Simply by coiling cable in a box, first of all, no one will pay to connect to a market that coils cable. They'll pay a lot of money for a fast cable and to be right next to something, but we've coiled cable in a box, and what it's done is it's actually eliminated about half of the high-frequency trading that you see in other markets. We have about 20 to 25% of the volume on IEX comes from proprietary high-speed trading firms. That compares to a 50 to 60% number or higher in other markets. And it tells you, again, not all high-speed traders are trying to hurt the market. Many of them make the market more efficient, but a lot of them require the speed that exchanges sell. And IEX, by slowing down these players, actually has deterred a lot of those high-speed trading practices. We don't pay rebates. We have a simple, transparent, flat fee. If you trade, you pay. Everyone pays the same price, no matter how big or small you are. This is a chart of IEX's growth. So from Q4, when we launched at 13, we've been quoted, or people have quoted us as being the fastest growing stock market in history. Our first day of trading, we did 568,000 shares in volume. 2 weeks ago, we did 414 million shares and traded almost $10 billion in notional. So IEX has been growing quite quickly. A lot of our growth has been fueled by the support that we've gotten from asset owners and many of the asset managers out there. IEX in many ways is I think, a very small sample of what's possible. When Michael Lewis wrote the book, it was funny. He said, if IEX doesn't work, I'm never going to write a book about finance again. His very first book was called Liar's Poker. And the irony of that to him was that he wrote Liar's Poker as a story about why people shouldn't want to work on Wall Street. And it turned out to be the how-to manual to work on Wall Street. I remember before I started my first job, I asked the people, what should I read? And they said, you should read Liar's Poker before you start on the trading desk. So he's kind of appalled by the fact that Liar's Poker is like the book to read before you join a trading desk. He said, I wrote Flash Boys because of this story. Because the story about people actually working on Wall Street trying to do something different. Another Wall Street scandal is not a story. It's like people trying to do something different. He's like, that's a story. And I think a lot of what this conference is about, what it stands for, is about people looking at their position in this industry and saying, what can I do differently? The way to think about how to break a cycle, how to break this historical cycle, or how to think differently, comes from understanding why history repeats itself. So if you think about it, it all starts with a scandal. This goes back 100 years. You can line up any number of things. It all starts with a scandal. And that scandal creates the need for some kind of regulatory response. Right? Scandal, people are outraged, there's a regulatory response. There's no such thing as a perfect rule. Regulations will always have loopholes or inefficiencies. Always. There's no such thing as a perfect rule. And those loopholes and inefficiencies are then exploited. Our industry has a way of exploiting loopholes and inefficiencies instead of solving for them. And that exploitation becomes so egregious, it leads to the next scandal, which leads to the next set of rules, which leads to the next set of loopholes, which leads to the next exploitation, and around we go. And this is how people are shocked. They said, how can all this happen right after the financial crisis? And how can all that happen right after the specialist scandal? And how can all that? It goes back and back and back and back, and because this cycle continues. The highest margin businesses, unfortunately, in finance are the least transparent. And that has to change. The other thing that this cycle does, scandals reduce the amount of talent that want to work in this industry, especially in today's world. We've never lived in a more transparent society. There are so many kids that are staying away from finance because of all the scandals. They feel like the decision to work in finance puts them at odds with their own integrity, who they want to be. And that's a problem, because those are the kind of people that can actually help us change the industry. The other thing it does is more and more regulation actually decreases the amount of innovation in our market. Regulation creates walls. Every new set of rules creates higher walls. And as the walls go up, the unfortunate part is the only people left inside the industry are the people who are causing the scandals. So in many ways, Wall Street, finance, the industry almost has to disrupt itself to get real change. I was lucky enough, I got invited to a dinner with Eric Schmidt from Google. There were 6 of us there, and he asked the question, why hasn't Wall Street been disrupted? And as we went down different paths, every path that ended in, the regulators won't let you do that. Or, there's regulation that says you can't do that. He changed the subject. So you have very, very smart people looking at the world of finance, but it's so heavily regulated, it keeps real innovators out. Innovators don't want to be slowed down by regulation. The cycle continues. So how do you break the cycle, right? You have this cycle, it goes around and around, and really in a way, what IEX is a single market-based solution to a known loophole and inefficiency, the fact that exchanges sell speed. And exchanges shouldn't be selling speed. IEX is a market-based solution. So when I'm down in Washington and I'm talking to the SEC and I'm talking to different people, I said, listen, the rules are the rules, but we've chosen to do something different within the rule set. And what it does is it actually, instead of trying to exploit the loopholes, when we first discovered latency arbitrage, when I sat at RBC and we tested it out and we figured out that people were racing us back and forth, I'll never forget it. I went home that night and I thought about it. And I said, you know what? There's no way in the world we were the first people to figure this out. I don't think we were 5th or 10th, maybe we were 15th or 20th. Every single person who had figured out that this game could be played by racing between the exchanges, figured it out and went to play the game. The quickest way for me and my colleagues to get rich was to go back out there and exploit what we had discovered. The problem is the world's changing. I don't want to be the 15th or the 20th person to do that. You want to be the first person to actually go out there and say, this is the real problem here. The other aspect was that I took my job seriously. The fact that I represented retirements, the fact that I represented pensions, the fact that I actually represented the savings of so many people, every time I had a trade, I felt like I had a duty to my client to actually do the right thing. And here all of a sudden you figure out that we're being electronically front-run. That was a huge problem to me. But market-based solutions actually prevent exploitation. If you prevent exploitation, you prevent the next set of regs the next scandal, which prevents the next set of regulation from being written. And in a way, market-based solution brings back talent. Why are we getting so many resumes from so many different places? We've hired people from all over different parts of the industry. It definitely helped with Flash Boys being written. When 60 Minutes aired, I had 500 resumes by the end of the night. I had more LinkedIn requests than I actually had connections within 15 minutes. It was unbelievable. But the fact that we're bringing talent back to the market. More talent leads to more innovation. You want innovators in this market. You want people to think differently. People in this room can go out, start their own companies, and do things entirely differently, and they can attack a new set of loopholes. We have to create a different cycle. And if you look at other industries live in this cycle. Tech, healthcare to a degree, right? Consumer. Finance needs to live in this world. And this world, the reason this world doesn't exist is because so many people in the system don't want it to exist. What can you do to change this? First of all, you have to ask questions. Why is this happening? Seek transparency, right? Go out there, ask questions that are hard to answer. Most importantly, vote with your feet. IX would not be where we are today without the support of asset managers, asset owners. This is your market. Brokers are middlemen. Many of the brokers control the majority of flow, but at the end of the day, this is a market built for asset owners and asset managers. You got to vote with your feet. Every single order makes a difference. I'll take a 25,000 share order, I'll take a 5,000 share order, I'll take a 1,000,000 share order. It all adds up, it all makes a difference. And one good experience leads to the next. Just to summarize, that 9 people turned into 17 people in a 200 square foot room. The fire marshals probably would not have been pleased with that. Our computers made the room about 100 degrees, but we finally raised the money. When the book came out, a lot of people were skeptical. And they said, how can IX is a for-profit entity? Why aren't you a not-for-profit entity? They said, how can you do the right thing and make money in this world? And at the end of the day, they're not making money and doing the right thing are separate decisions. You're not necessarily going to make less money by wanting to do the right thing. I think it has to do with the time frame you evaluate yourself on. Making as much money in the short term typically involves taking shortcuts, not caring about your clients, caring about your next incentive pay. Taking a long-term view. We like to say to ourselves that we're long-term greedy. We believe we can make a lot of money, but we believe we can make a lot of money doing good. Just moved in to new places, a new office. IX is now 62 people. We've raised over $100 million in capital. I don't say those things as saying that we've gone on a different path. We're on the same path that we've always been on. We just feel like we can do more good by being more successful. We can inspire people to do things, to try to break that cycle by doing them the right way. And that's really what our goal is. And that's the end of that, and I'll take any questions anyone has.
Thank you.
Yeah, thanks.
Do you want to sit down for us? So thank you, Brad. This was extremely interesting and relevant, I think, for investors today. So maybe I could go back to, and we're a little bit over time, but we'll allow 2 or 3 questions from the audience. I just wanted to start by asking you about this, the relevance of this for asset owners, which I mentioned at the very start, and you mentioned this as well. Is it your impression that asset owners have sort of lost touch with the markets in which their assets really are traded? And if so, what should they be doing about this?
Sure. So I think there's a bit of an agency problem in the market. People pay other people to be experts, and then implicitly trust that those experts are going to guide them in ways that are always in their best interests. And I would say that when you think about the incentives that are out there, the incentives for many of those fiduciaries are not aligned with your interests. So I'd say it starts always by asking questions, always by understanding what their motivations are, understanding how they're compensated, and then looking to align yourself with people that really are aligned and compensated and kind of in your best interests. It all starts at the top of the chain and rolls down. And what you've had is asset owners relying on asset managers relying on brokers, and brokers relying on exchanges a lot of the time. And at the heart of that, the farther down the chain you get, the more the incentives change. And the farther away from something you are, the more that you're going to be the victim, unfortunately. You know, information asymmetry is probably the best fundamental explanation of finance. If you have more information than the person you're trading with, you're going to win more times than you lose. More information is held with the exchanges and then with the brokers than at the end, and what you need to do is you need to try to find some kind of parity there. What we're trying to do at IX, the reason I travel and speak is because I want to educate people and kind of help balance that a little bit.
Well, thank you. So similar actually to many of the other responsible investing issues that we've been talking about, that the issue really, you have to address it at the top of the chain in order to make change. So, it's a bit difficult to see hands from up here, but there is one there, and there's a microphone on its way to you.
Brad, when you were rich enough to fund the next market-based solution, and you scanned the horizon for loopholes and exploitation, where do you think you might fund the next innovative market-based solution?
Sure. So we've been lucky enough that the money that we raised, we still have. So we raised $75 million last September, and we still have it. So we're looking actively ourselves at IEX at different places. Digital currency is a place that we see that has immense potential, but has some serious brand issues. We've looked at digital things, as remote as, digital advertising, and, how 50% of what happens in that market is deemed to be fraudulent. We've looked at different geographies and different asset classes. They're all kind of unique. A lot of what I talked about here was US based. But this model of exchanges and fragmented markets and selling access, has made its way to other asset classes and other geographies. So, we're actively looking at ways we can kind of apply our business philosophy to other things. The private markets are another. More companies are staying private longer, and that's a very inefficient process for matching investor demand with the supply of good private companies. So. One of the things we've been very lucky about is that we get pitched business ideas, almost daily, and it's really just about picking the next one for us to get into, and that should be coming soon. We're launching as a stock exchange, hopefully the beginning of the year next year. This will give us the ability to list public companies and kind of enter into that exchange world. That's our first focus, but we are actively looking at other areas.
Great. One more question before we have to move on. Do I see any hands? There's one over there. There's one over there.
Brad, now that you're successful, what do you see as risks and temptations now that with your newfound fame?
Yeah, I think it's a bit early to deem success. We're still fairly new. We haven't been launched for. We've been live for about 18 months. I think the temptation, and it's happened a couple times, we've had a couple exchanges try to buy us. And, that we've turned down those offers. And that it actually would have made a lot of people at IEX more money than we ever imagined having. The reason we turned it down is because, the price the exchanges were willing to pay was not a large enough sum to really not be a defensive purchase. We want IEX to accelerate someone's desire to do good, not to be a protection against what they're currently doing. So, we've been tempted. It wasn't, it wasn't a long discussion. We just basically, looked at each other and said, we're not doing it. So I think for us, the mission's more important than what results from that. Not to say that we're not capitalists, we absolutely are, but I think, again, making money the right way and doing it with a focus on the long term, that's really kind of been our thing. So we also realize that our brand is based on people trusting what we do and what we say, and that brand could be damaged with any small mistake. And so I think that's something we're very cognizant of. We're very fortunate to be in the position. So I think temptations will arise, and it's just our duty to our investors and to the people who support us not to kind of fall for that.
I think there was actually two questions simultaneously. We'll take and that will be the last question. Yes, please.
Yeah. Mark Mansley, Environment Agency. Just looking, as you move to become a stock exchange, obviously that will then involve you in listing and listing rules and listing standards. And I'm wondering if you're going to take some of the values and mission and integrate that into actually setting higher and more investor-friendly lister standings than other stock exchanges do.
Yeah, that's a great question. It's not something is there media in the room?
Yes.
There is? Okay, I'm not sure. You know, part of the reason I'm here is that we've taken a very keen interest in those standards. And I think that, an exchange's responsibility is to try to influence others to make good decisions as well. And I think that, what you'll find, I can't comment specifically because it's in, the regulatory process now, but I think what you'll find is that, our standards will be very high. The goal for us is not in quantity of companies that will list on IEX, it's on the quality of company that will. And I think that will align very closely with this mission, which is part of the reason I'm here and got kind of involved in understanding more and looking to apply some, the principles that are being discussed here in the things that we're doing at IEX. I think they align very, very closely. So thank you for that question.
Well, thank you. I think this was a great way to start this day, I think, and it ties into so many issues about the responsibility of asset owners, about the nature of markets, about systemic risk factors that are really issues that we'll come back to. Well, best of luck in establishing your exchange and listing, and I, of course, hope that you'll join our Sustainable Stock Exchange initiative. So thank you again for coming, and let's thank you for your participation.
All right.
Great, thank you. Thank you very much.